Hey, all right, let's start with the fantasy because most of you are living in it. You think war is something that happens over there on a map, on a screen. You think it's a political problem for politicians, a military problem for generals, and maybe a humanitarian problem for people who donate to relief funds. You think your savings account, your mortgage, your retirement portfolio, your small business, your job, you think those things exist in some separate, insulated universe where geopolitics can knock on the door but can never actually walk in. Let me be very direct with you. That belief is going to cost you everything. Because here is what is actually happening right now, and I want you to pay attention because the people around you are not paying attention. The war is not a regional incident. It is not a contained crisis. It is the opening chapter of a fundamental restructuring of the global financial architecture. The same architecture that holds your money, determines your purchasing power, and decides whether your savings grow or evaporate over the next decade. Wake up or lose everything. I don't know how else to say it. So let me show you exactly what I mean. Okay? To understand what's coming, you have to understand the system we've been living inside. After World War II, the world built a financial order from the rubble, Bretton Woods. The dollar as a global reserve currency, petrodollar recycling. The IMF, the World Bank, the SWIFT system. The whole architecture was elegant in its own way. It was designed by the victors of one catastrophic war to prevent another one. And for about 70 years, more or less, it worked. Not perfectly, not fairly, but it worked. Here's the critical thing you must understand. This system was never just economic. It was always geopolitical. The dollar's status as the world's reserve currency isn't because the dollar is inherently superior. It is because the United States had the military power, the institutional leverage, and the global network of alliances to make the whole world transact in American paper. The dollar is backed by aircraft carriers. Always has been. Now, what happens when you start escalating a war in a region that sits at the intersection of critical energy corridors, rare earth supply chains, and competing great power ambitions? What happens when the 2 or 3 largest non-Western economies start actively building alternative settlement systems, alternative commodity exchanges, alternative reserve currency arrangements? What happens when the sanctions regime, which was the West's primary financial weapon, gets used so aggressively that every neutral country on earth suddenly has a very rational incentive build a backdoor of the dollar system? You get a fracture, a slow grinding fracture in the foundation. And the person who doesn't see it coming is the middle-class professional in a Western city who thinks their 401k is just fine because the stock market went up last quarter. Let me walk you through exactly how this plays out. All right, here is the architecture of how war escalation destroys your money. Not metaphorically, mechanically. The first channel is energy. Every modern economy runs on energy. And the price of energy is embedded in the price of everything. Groceries, manufacturing, shipping, heating, data centers that run the digital economy. When war escalates in or near major energy corridors, and let's be precise here, we're talking about regions that affect oil and natural gas flows, you don't just get higher gas prices. You get a cost-push inflation event that is fundamentally different from the demand-driven inflation central banks know how to manage. The Fed can raise interest rates to cool consumer demand. It cannot drill oil when energy costs spike because a shipping lane is disrupted, because an export terminal is damaged, because insurance premiums for tankers in contested waters triple overnight. That cost moves through the entire supply chain like electricity through wire. And here's the cynical part. The central banks will raise interest rates anyway because that is the only tool they have, which means you get the worst of both worlds. Inflation eating your purchasing power from one side and higher borrowing costs crushing the value of your assets and your business cash flow from the other. Now, second channel, trade disruption. We built the global economy on just-in-time supply chains. This was brilliant in peacetime. It is catastrophic in a conflict environment because just-in-time means no buffers, no inventory, no resilience. When a war escalates and you start seeing shipping route diversions, port closures, sanctions lists that expand weekly, export controls on semiconductors, dual-use technology restrictions, suddenly the manufacturers, the retailers, the technology companies that are publicly traded in your portfolio cannot source their inputs. Lead times blow out, margins collapse, earnings disappoint. The stock market, which is a discounting machine for future corporate profits, starts pricing in a structurally lower profit environment. You open your brokerage app and you see red. And you don't understand why. This is why. Third channel. And this one is the one that most financial commentators refuse to discuss honestly because it is the most unsettling. Reserve currency erosion. I told you the dollar is backed by geopolitical power. Okay? What happens to that power when the United States and its allies are stretched militarily, financially, and politically? What happens when Russia, China, Iran, Saudi Arabia, and increasingly India, Brazil, South Africa start settling commodity trades in currencies other than the dollar? What happens when the BRICS nations actually operationalize an alternative payment rail? Not because it's better, it doesn't have to be better. It just has to be good enough to reduce dollar dependence. This is already happening. Not in the future. Now. And the consequence of this, let me be precise, is that the global demand for dollars slowly then suddenly declines. Which means the United States can no longer export inflation so easily. Which means the Treasury cannot finance its deficits as cheaply. Which means interest rates in America have a structural upward bias that doesn't go away when the Fed pivots. Which means the cost of carrying debt, government debt, corporate debt, your mortgage, your car loan stays elevated for longer than any of the optimists are modeling. This is what dollar hegemony decline looks like from the inside. Not a sudden crash, a grinding, decade-long erosion that slowly lowers living standards, slowly makes everything more expensive, slowly makes the life you plan for yourself, the retirement, the house, the security, a little harder to reach with every passing year. Fourth channel. Capital flight and currency pressure. When wars escalate, risk perception spikes globally. Institutional capital, the big money, the sovereign wealth funds, the pension funds, the hedge funds starts moving. It moves toward perceived safety. Historically, that safety trade was the dollar, US treasuries, and gold. That trade still partially holds. But increasingly, in a world where US geopolitical reliability is being questioned, the safety trade is fragmenting. Some capital moves to gold, some moves into hard commodities, some moves into specific currencies with trade surplus fundamentals, some simply sit still because the uncertainty is too high to make a bet. What does this mean for your money? If you're in a smaller economy, your currency weakens against the dollar and against hard assets. Your import prices explode. If you're in the United States, the dollar's safe haven premium gives you temporary protection but masks the underlying deterioration. You're in a burning building that happens to be the safest building on the block. Let me stop here and make this visceral for a moment, because I don't want this to be an abstract lecture. I want you to actually feel the stakes. Imagine you spent 20 years building your financial life. You paid off most of your mortgage. You contributed to your retirement account every single month through the discipline and sacrifice of deferred gratification. You built a small business. Maybe. You made choices. You built something. Now imagine that a war you didn't vote for in a region you could barely find on a map 5 years ago triggers an energy crisis that spikes inflation to 8, 10, 12% for 3 consecutive years. Your retirement account, denominated in a currency that is slowly being cut out of global trade networks, loses real purchasing power even if the nominal number stays flat. The interest rate on your business loan doubles. The customers who used to buy your product or service are now spending 60% of their discretionary income on food, energy, and debt service. They stop buying from you. Your business cash flow goes negative. This is not a hypothetical disaster scenario. This is a historically documented pattern. It happened in the 1970s. It happened across multiple emerging markets in the 1980s and 1990s. The only difference now is that the scale of the conflict environment is potentially larger, the financial system is more interconnected, and the mechanisms that used to absorb these shocks, American hegemony, dollar dominance, the multilateral institutional order, are under simultaneous pressure from multiple directions. The comfortable class always thinks it won't happen to them. They always think that somehow their specific corner of the system will be insulated. They are always wrong. So what do? That is the only question that matters. Understand this clearly. There's no perfect hedge. Anyone selling you a perfect hedge is selling you something. But there are rational responses to a structurally more dangerous financial environment, and they are not complicated. You diversify your exposure. Not just across asset classes within a single currency, but across currencies, across commodity-backed assets, across geographies that have legitimate trade surplus and resource endowment. Gold is not a relic. Hard assets that are embedded in the real economy. Energy infrastructure, food production, water. These are not romantic. They are rational in an environment where paper promises are under stress. You reduce leverage. Debt is an amplifier. In a benign environment, it amplifies your gains. In a volatile environment, it amplifies your destruction. If this war escalates and the macro environment gets genuinely hostile, the people who survive financially are the people who are not leveraged to the edge of their tolerance. You stay informed at the structural level, not the news cycle, not the daily narrative. The structural level. Who controls which resources? How the settlement systems are evolving? Where capital is actually moving as opposed to where commentators say it should move. The person who understands the architecture of the system has an enormous advantage over the person who only reads headlines. And you take seriously the possibility that the world you are preparing for financially is not the world of the last 40 years. That era, low inflation, dollar hegemony, globalized supply chains, falling interest rates may be structurally over. Prepare for a different world, because pretending the old one still works is not a strategy. It is just another version of the fantasy I started with. All right? We've covered the mechanism today. The 4-channel, energy, trade, reserve currency erosion, capital flight, and how they translate war escalation into real losses in your specific financial life. But here's what we have not yet touched. We have not talked about which specific asset classes historically outperform in multi-year war cycles. We have not talked about the BRICS payment rail architecture in detail, how close it actually is, what its real limitations are, and at what point it becomes a genuine threat to dollar hegemony versus just a political statement. We have not talked about the history of what happens to the middle class in the country that loses reserve currency status, and there is very specific, very sobering historical data on that. Those are the next chapters, and they are more important than what we covered today. If you're serious about understanding how to protect yourself in an era of genuine great power conflict, not the sanitized version, not the optimistic version, the real version, then stay in this conversation. Because what I'm going to show you next is the part that most financial analysts are still refusing to model into their scenarios. The war is the context. Your money is the consequence. And the gap between understanding that and not understanding it will define a great deal about your financial future. I'll see you in the next one.